Hello and welcome to Business Television India. I'm Siddharth Zarabi and I have with me 4 tax experts discussing the fine print and the fallout from Budget 2018. MS Mani, Senior Director at Deloitte India, Riaz Thingna, Leader Direct Tax at Grant Thornton, Abhay Sharma, Partner at Shardul Amarchand Mangaldas, and Puneet Shah, Partner at Dhruva Advisors. Thank you very much, gentlemen, for joining us here. The big move really has been on long-term capital gains, and perhaps I'll come to you, Puneet, first before I go to Riaz and then Abhay on that side. Puneet, explain to our viewers whether this is the best case scenario that could have panned out as far as long-term capital gains is concerned.
So I think there's a lot of speculation for last several years in terms of whether the long-term capital gains on listed stocks should be taxed. There are a lot of gains being made by the foreign investors, by the FIIs, by several other investors, and which is going untaxed just because it's more than 1 year. Long-term capital gains are not taxed on the listed stocks. The speculation was whether the holding period would be increased from 1 year to 2 years or 3 years, or whether the long-term capital gains above a particular threshold, say 10 lakhs, would be taxed at a particular rate. Those kind of speculations were going on. I think this was not something which was really envisaged by anyone. So what has happened is it's flat taxed at 10% above 1 lakh. 1 lakh is a very, very minuscule sum in that sum. So essentially 10% tax rate for all the long-term capital gains going forward basis. The only thing I think keeping in mind the promise which has been made by the current government on the no retrospective amendment, the grandfathering has been provided. So the cost up to yesterday, 31st January 2018, should be considered the fair market value or the listed price yesterday, whichever is higher, should be considered as a cost going forward basis. So I think that's a good development in that sense. Considering the cost which is higher than your actual cost of acquisition. So it's not a retrospective in that sense. So I would say yes, it's something which was in offing, and something the way it is done is not unfair in that sense.
It's not unfair. Riaz, I want to come to you, and on a broader point really, because you know the immediate reactions have been absorbed. Over the last 15 months, we have seen that the economy was financialized. A message willy-nilly was provided to people, to investors, to savers, that go invest in financial asset classes, and equities became one of the more favored ones. Domestic inflows into the markets have replaced foreign inflows. In such a situation, on one hand, you financialize the economy, and then very smartly, can I say, that 12 months later, you decide to impose tax.
Yeah, but let's face it. I get your point, but let's face it, that the government had very little choices. How are you going to mop up revenue? And it was also an election budget. You needed to make sure that investments and flows went into the right directions, agriculture, etc. So it had to be financed. We also had to make sure that some SOPs were given to in terms of personal tax, etc. So I think by and large, there's long-term capital gains had to come in some form or the other.
So is this the first phase? Is there a second phase in the offing 2 years down the line, 3 years down the line?
Exactly. So let's see it in perspective. So firstly, if we had spoken about just increasing the holding period, that holding period would have made more sense, because by no stretch of imagination can you say 1 year is long term. So increasing the holding period from 1 year to 3 years would have been the more logical thing to do.
Without the 10% imposition.
Without the 10% imposition.
But that wouldn't have happened because the revenue need is now and next year rather than 3 years down the line.
So it is the immediate needs which have created a problem. The real unfair position here, I think, is that STT continues. Now, STT was supposed to replace long-term capital gains tax. That continues. Now we have a 10% long-term capital gains tax. We can argue that it is in alignment with the trends across the world. Globally, most economies tax long-term capital gains. So we can argue, but what happens here is that with STT, it means that there is an unfair, it's not a level playing field.
Yeah,
listed securities
and on that point,
versus unlisted securities.
And on that point, just to break it up for our viewers, the point that you made about global comparisons, we can also see the global comparisons of what LTCG treatment is across major economies, all those details there. But you use the word unfair, and to take this discussion forward, allow me to take that point to Abhay. Abhay, what Riaz was just talking about is the unfairness of having a LTCG, then having a securities transaction tax, having dividend distribution tax, and short-term capital gains tax remains. Right. Is this like onerous? In terms of the treatment, is India in a unique position, or do other domains, tax domains, also treat equities in the same manner?
Okay, so in terms of it being sort of unfair, I wouldn't call it necessarily unfair, but yeah, this particular move was essentially going after low-hanging fruit. It was simple to sort of do, to say that we will tax long-term gains at 10%. I think where we are slightly different from other jurisdictions is, as you mentioned, on the dividend aspect. You see, a lot of jurisdictions tax capital gains. That is not new. The part where it actually starts to sort of pinch is where you then impose this dividend distribution tax, which in the Indian context is extremely unique, because it is not imposed on the shareholder. It is imposed on the company. So the shareholder quite often doesn't get credit for it back home in his home jurisdiction as well. But that's where it sort of really the cost of tax really starts to multiply, and you're effectively you may sort of end up with not just 10%, but a much higher rate. So yes, that is something which they sort of should have ideally kept in mind.
One small point on this subject before I move on to other topics, and I'll come to both of you also. But Abhay, so short terms at 15%, this at 10%. Right. That leaves what would be called hypothetically arbitrage gap really. Will this difference somehow influence investor behavior? Do you think, from a tax practitioner's point of view? Because tax planning is justified, tax avoidance is not. So I'm using that as a corollary to.
Look, to be honest, it sort of to my mind, it creates a bit of a disincentive for now actually sort of holding on for more than 12 months, because the arbitrage will actually come down. Now it's only a 5% differential. Let
me take that. Puneet, does it create a disincentive?
So clearly, I think I agree with Abhay that now above 12 months it's 10%, below 12 months it's 15%. So arbitrage has substantially come down. In both cases, it's supposed to be STT paid. And therefore the difference is not very large.
So directionally, are we talking about 15% in the long term,
so
by 2019, 2020?
Yeah. So you talked about phase 2, phase 3 kind of thing. If you look at non-residents today, foreign investors or FIIs, or trading on stock exchange.
Correct.
If it is or other non-resident which are on unlisted stocks. I'm just comparing with the unlisted stocks and non-listed stocks. The rate of tax for long-term capital gains is 10%.
Okay.
So I would say that this 10% rate is in parity with unlisted stocks.
So short-term could also fall to 10?
So short-term is 15% today. But for short-term for residents, for example, is much higher. It's 30% or 40% in that sense. So there is no method in madness, so to say. What I feel is that the 10% could be the rate. I don't think.
A sort of benchmark rate.
Yeah.
But Riaz, I want to ask you this. The Arvind Modi panel and the DTC revamp. I know politically there is now no time left to take that call. But if that report comes sometime mid this year and then it goes through whatever motions, this Lok Sabha will get voted out. It will get replaced with the new Lok Sabha. Can the DTC be the place where all of this unfairness and irrationality get sorted out? Are you hopeful? Because I was hopeful of that 10 years back, but no longer.
Yeah, it's a good point, because the DTC, I think, has gone through 3 attempts. And we've not really seen the light of day. So we don't really know when it will come true. talking about being rectified under DTC, if we talk about the imposition of the long-term capital gains, this is more or less in line with what we have been doing so far. We have negotiated our treaties with...
My point, Riaz, for our viewers was to look forward. I'm saying, can DTC be the forum or the document or the agenda in which all of the irrationality can be weeded out?
No, absolutely. I think that's the main purpose of the DTC, so it can be weeded out. What I was trying to make a point here is that while we are saying 10%, I think is...
Now here to stay.
Here to stay. I'm not too sure whether the short-term capital gains would go down to 10% or would it go higher to create, because I think it will be the other way around.
And the point I think that needs to be recapped here is that this is not the first time long-term has come on equity. It has made a comeback, frankly.
Absolutely.
So, I want to add 2 points. One is on the STD point which was being made. There are several instances where shares have been issued or acquired before 31st January 2018 where STD is not paid. So all the IPOs, all the acquisitions of unlisted shares which have been now listed are not STD paid.
Okay.
And therefore the 10% concessional rate of tax will not be available when those shares will be sold.
So go ahead.
I just want to add another point, but just go ahead,
Just on that point, what I would anticipate is that the government will, as they have in the past as well, there's a similar provision was brought about last year, they will notify a list of transactions where even if FTT hadn't been paid, it will still fall within the ambit. So it's
we'll
sort of
wait and watch.
I would anticipate that there will be a notification.
So that was that they would come up with a list of...
But that was for 1038
and hopefully
they came out with that
March end.
Correct.
Memorandum has something along those lines.
So that was one point which I wanted to make. But the second point which I feel is again a miss maybe is that for FIIs, they are not provided for this 31st January 2018 as a threshold for considering the increased cost of acquisition.
Okay.
So what has happened is for all investors, you have a option of taking 31st January 2018 as a increased cost, which will be considered for your computation of capital gains. But for FIIs,
it won't.
When they amended that section 115 AD, I think they have missed it out.
Okay.
So today, when FIIs sell it, anytime from today or tomorrow onwards, the cost may be the original cost and not the enhanced cost as of yesterday.
On that note, we'll slip into a short break. When we come back, we'll continue our discussion on the tax architecture proposals in this budget. Don't go away. Welcome back. We are discussing the tax side of Budget 2018. I'm going to change the tone towards a subject which is no longer there virtually in the budget, and this is the indirect tax side. There are some components. Earlier on in tax panels, you were easily able to divide equal time between direct and indirect tax, and MS Mani, who is here patiently with us, now has the job to sort of tell us the fine print from the indirect tax side. You know, we have had many mini budgets via the GST Council, really, so that's a subject we are not dealing with today. But from the fine print, whatever is left of indirect taxation, what has potentially the maximum impact? If you could share some details with us.
Okay, so I think it's not a correct statement to say that the budget didn't have indirect taxes, because the customs duty changes that we have seen in budget...
With that exception, of course.
Yeah, the customs duty changes that we have seen in budget are kind of unprecedented.
Okay.
Now, I'll tell you why these are unprecedented. For the last 15 years or so, since India is a signatory to the World Trade Organization and the World Customs Organization, it has been necessary to ensure that the customs duty rates on various products are bound by the international convention. And therefore, in every budget, we would see the customs duty rates going down.
We have broken with that trend now.
And I used to, at some point of time, wonder how much more will it go down.
So because we had come Make in India customs duty.
Now, okay, now it could lead to
barring gold.
Yeah, it could lead to manufacture, because we have seen customs duty changes today on virtually a broad spectrum of products, all of which may or may not be made in India. So we have seen them, for instance, on watches and clocks. We have also seen them on smart watches and wearable devices. I don't think we are planning to make wearable devices. We have seen them on certain products which are very, very specific, you know, such as a cochlear implant which is used by certain kinds of people. We have seen that also. So to my mind,
I would argue that wouldn't some of these items and it's a very interesting mix of items that you speak about that have been impacted. I would say that it's like a run-up to general election kind of soft giveaway, upper middle, smartwatch wearing kind of people are going to perhaps get it a few rupees, a few dollars cheaper in India. So that is the idea, because I completely buy your point. It's not going to be manufactured here.
Yeah, so therefore, if we look at the range of products, all toiletry items, it has gone up. So aftershaves are more expensive.
Yeah. So there's a clear make in India bias.
Sunglasses are more expensive.
So there's a clear make in India bias.
Now, when we look at that, what we have to bear in mind is that for all of these products which are imported, for domestic manufacturing to set up and start and accept and do that, there is a time lag. Could be 6 months, could be a year, depending on the product, right? So during that interim, there is going to be some kind of a price increase. Okay. Now that price increase is, to my mind, going to be absorbed by the middle class. Because, see, the intention is not to look only at products which are consumed by the richer sections of society.
Why would that happen? Wouldn't there be a decrease in imported, and wouldn't the domestic FMCG companies step in? Because we have a very large FMCG base in India.
Yeah. Now, if these were restricted to products which are where India is strong in manufacturing, I would buy that. But the mix of products that we have, seen. So for instance, toys and games. All toys and games.
Electronic games or board games?
Board games and toys and games and video games and everything else has gone up. And again, just bear in mind what is the quantum of increase. It's 100%. It's from 10 to 20, which has gone up. So to my mind, when we are looking at a customs duty increase, which is the most significant in recent years.
What has happened to mobile phones? Because that's one of the largest sort of consumer categories. The joke, as we know on our e-commerce platforms, is that mobile phones account for, a majority of the volume, but the lowest in margin terms. And jewelry accounts for the largest in margin terms, but the lowest in volume terms. So what's happened on mobile phones?
See, as far as mobile phones is concerned, we already had an increase 2 months back, where it went up from 10 to 15. And today we have seen it going up from 15 to 20. Very interestingly, even the parts of a mobile phone, so the battery of a mobile phone, the charger of a mobile phone, even they have gone up.
Okay.
So ranging between 7.5 and 10 to 15.
So therefore, if you are manufacturing a phone in India, and there are several companies,
absolutely,
they stand to benefit.
They stand to benefit. But here is the catch again. Whether it is mobile phones, whether it is watches, whether it is various items which are mentioned, the segment that manufactures in India and the segment that is imported is entirely different.
Completely. There's a sharp distinction.
There's a sharp distinction in terms of the consuming class. And therefore, an across-the-board increase is certainly going to increase the price.
So therefore, Mr. Mani, this is not the first time you have focused on this subject on our channel. You explained this to us in the past also. In summation, what is the change? Like you said, many years back, we were bound by tariff commitments that we had made. Today, if India has broken away with what prevailed almost as a consensus during the Manmohan Singh years, particularly so, if Narendra Modi and Arun Jaitley have broken away, what is the purpose behind it? What is the strategy you divide?
I don't think we have broken away, because we are still within our commitments. So we had brought it down below commitments. Now we have gone up to our commitments. The larger issue over here is customs duties on products have gone up sharply by almost 100%. That is going to lead to some kind of a inflation.
Cost push
and inflation, number one.
Number two, this is on a variety of products which are mass consumption products. This is not on certain selected products.
So this is a revenue mop-up exercise to plug the fiscal.
Quite possible.
Quite possible.
And on the positive side, what we have also seen is, on the custom side, there are a lot of trade facilitation measures which have been made, which are to make life easier for importers and exporters.
Well, that's part of the ease of doing business. That's the exercise that we know. So the point, really, in quick summation here, if you are looking at from a broader macroeconomic point of view, that perhaps, as MS Mani was telling us, there's been a significant cost push which could in the short term yield to some changes as far as the inflation indexes are concerned, because remember, any index, including particularly either the wholesale or the retail index for our prices, they have multiple categories and items that have specific weights in them. So it would take some more time for economists to do the fine print analysis, but there's definitely, as MS Mani is saying, it's clear that a cost push has been introduced, which will perhaps pan out negatively on inflation and will have consequences as far as interest rates are concerned. Maybe not to the quantum to be worried about, but a bare mention might be adequate at this stage. Before I conclude this discussion, I want to go back to the other bit, and this is the personal income tax side, because on the corporate side, 50 has become 250 crore. But actually, Riaz, on this 50 to 250 crore, what's the rationale? And those who have been left out, after today, does their effective tax incidence, the large corporates, remain the same, or has it been altered?
No, for the large corporates it remains the same, and really we are left, after this change, we are left with the really large enterprise. So while we talk about 99% coverage today, that 1% really constitutes the real large
companies. It's the same volume versus margin.
It's absolutely a volume versus margin game, and they don't stand to benefit. I think it was the time was not ripe enough to be able to extend the larger volume of benefits.
Yeah, so it's an incremental step, right?
But if I may just refer to the roadmap, which was laid down by the finance minister a couple of years back, to systematically reduce the tax rate from 30% to 25% over a period of
not happening.
3 to 4. That's not happening.
That's absolutely.
So now this 25% is only for turnover, companies having turnover of 25 crore, 250 crore, long way to go.
Can I argue with you, Puneet, that in 2015 when that announcement was made, it was the first flush of this administration.
Yes.
It was the first full budget.
Understand.
And the macroeconomic headwinds were looking very favorable. So from an overall tax administration, finance administration point of view, it was the best time to make an announcement. Perhaps reality started to set in subsequently.
Correct. So I think that exactly seems to be the point. And I'm surprised because...
so that's one promise that he has not adhered to.
That's the point.
But did anyone seriously expect it to be adhered to?
I think so. On this channel we discussed that. That is going to be implemented.
Well, the media doesn't set the agenda.
And the second point is the US tax reforms.
So yeah, that's a very good point.
Yeah. So now
I think we have recognized, and from an indirect tax. So if you look at it overall from a tax policy point of view, the fact that we are ignoring what the US and UK have done, and possibly some other advanced economies may end up doing during this calendar year. Remember, in the Western world, the calendar year has just started. These exercises are sometimes carried out post-April in some of these economies. What you are looking at is that the Indian tax policy administration has seemingly ignored this due to domestic pressures, and has also changed tack on customs tariffs.
Yeah, just one point over here.
Sure, both of you, one by one. Yeah.
Just one point over here. While the customs duty increase is aligned with Make in India, that's fine. To my mind, one of the other agenda that the government would have is, if there is a shortfall in GST, it has to be made up some way. And customs is a very good way of making up the shortfall.
Mani, very quickly, I don't know if you track the overall collection numbers, but do you see strong evidence of a U-shaped recovery in GST revenues?
I would say that last month's revenues were actually the tipping point, because those revenues came on the back of a full month.
I asked Arvind Subramaniam just the other day that by when would we go to 1,25,000 crore? And he said, well, that's the most optimistic scenario that one could have. Is that so optimistic on the GST side?
1,25,000 is certainly very, very optimistic. I would be happy if it increases to between 90,000 to 1 lakh over the next 3 months and stabilizes at that level. If it stabilizes at that level, we are good enough. But the reason why customs duty on a large number of products has been increased, it's not on 1 or 2, could also be to make up fill up that gap and make that shortfall, and especially in the next 2 months.
And in some ways, slightly regressive, frankly. Abhay, you wanted to come in on that other point.
On the point of the 25%, just one sort of lookout, it will be interesting to see is whether going forward, corporates will have an incentive where rather than having one company with multiple divisions, to have smaller companies set up with the 250 crore threshold in mind.
That's a brilliant point. That's a brilliant point.
I may split.
And it will be genuine tax planning. It's not tax avoidance.
The point is, in that particular provision, which Abhay is referring
they'll
to,
put a cut-off date. It will be applicable to companies incorporated.
There is no condition of the splitting and reconstruction which they generally put, that you can't create companies by splitting and reconstruction, which is there in almost all sections of the Act except this section. So what he is saying is actually makes sense, that you can actually split up or reconstruct your businesses and create multiple companies. So I think it seems to have missed again, and it could actually be
very quickly.
Having said that, I don't think that companies of that size would be, they would be more concerned about the market cap and overall.
Because they know there is a body called Unlisted. Unlisted can do, but as far as listed or unlisted, they know that there's a body called the Large Taxpayer Unity all across jurisdictions in India, which will be on the watch out.
I mean, let's not restrict this to only existing companies. If I'm starting out today from scratch, and once I see that my company is reaching a certain size, and there's a separate line of business that I would want to enter into, I would legitimately set up a second company rather than having a second division in that company.
And I will intervene because we are completely out of time. But the point to take away from our experts and the very last bit is this: every time you do any change in tax architectures, and in a country like India where it happens quite frequently, an arbitrage opportunity gets created. And that's why very wise tax administrators, even from ancient times, have talked about stability and a long-term visibility on the tax path. Today's budget was an incremental step in that long journey. We have had taken 15 years to get here. Perhaps another few years before the direct tax side is also completely reformed. But with that, we are completely out of time. I want to thank my guests once again for this fascinating insight as we discuss the taxation fine print from Budget 2018. If you've been, thank you very much for watching.